we can incorporate into our financial plan to help prepare for the costs of long-term care and retirement. And just a quick story about me. This is something very personal to me as well, because I went through a long-term care event with my grandmother on my mom's side many years ago before I knew anything about long-term care. And my family, I had no clue what a long-term care event was, or even about Alzheimer's. So she was diagnosed with early onset Alzheimer's. If you're not familiar with Alzheimer's, it is the sixth leading cause of death in the United States. It's actually the second leading cause of death in California. And so when this happened to my family, we had no idea what to do. There was no plan in the beginning because it was early onset. Physically, she was okay. So she could still get around. Most of the time early on, it was just my family helping her and caring for her and really just staying with her and watching her. And then as she started to progress and get worse, she needed more and more care. So we ended up hiring somebody to come into her home. We tried to keep her at home as long as possible. And so we hired a home health aide to come in. And of course, as she needed more and more care, it started getting very expensive. So they started going through her assets pretty quickly and eventually ended up selling her house. They used the money from the sale of the house to have her stay in a facility. And it was about 3 to 4 years of her in a facility. And then we just started running out of money. So they went through her assets, they went through the money from the sale of the house. And at that point, when she had no more assets, that's when you can qualify for Medi-Cal, or actually, I'm originally from New Jersey. I've been in California now for 9 years. So in California, we call it Medi-Cal. In all the other states, Medicaid is the state funding. And we'll talk about that a little bit later. But when she was able to qualify for Medicaid, the facilities that my family looked at, they just were not comfortable putting her there, and they were really thinking she was only going to, make it maybe a few more months. So they moved her in with my mom, and my mom ended up taking care of her. They put a hospital bed in sort of like the second living room, dining room area, with a baby monitor next to it. And my mom ended up taking care of her for almost a year until she finally passed. And so when this was all said and done, it was about 7 years, and it was a lot for our family, from multiple aspects, but also just financially for my grandmother. I mean, she passed away with nothing. And I always share this story. So I talk about my grandmom a lot, but the plan was she wanted to leave all of her assets, including after selling the house, to me and my brother and my two cousins. So there was four grandkids, and there was more than enough there to put all four of us through college. So my parents never even saved or planned for college for my brother and I, because they thought, you know what, grandma had this taken care of, and everything was going to be fine. But when this was all said and done, from start to finish, unfortunately, there was nothing left. And so, I know that's not what my grandmother wanted, obviously. And one of the reasons that my family had no plan or never talked about it was because my grandfather, he had passed away years earlier from a heart attack. So he didn't need any long-term care. So it's very eye-opening. And for those of you on the line, if you've been through a long-term care event, some of this may sound familiar. Um, whether if you're a caretaker or have seen a family member go through it, but you would know the financial burden, right, and also the physical and the emotional burden. So I just share this story. I don't mean to bring everybody down, but it is personal, and I've been through it's real life. And so that's why, again, I'm fortunate to be able to help people plan for long-term care. And I think that's the number one goal today, is just for everybody to come away very educated on long-term care and what options we have. So I'll go through.
Thank you so much for sharing, Amy. And the personal story always speaks because you've been through it. I actually also experienced some of that on a very short term. And what I realized that it's very difficult for a family member to be 100% caregiver. So there is a term of caregiver burnout. It happens all the time. It really requires more than just one person to take care of elderly properly, especially if you need medical care. And it's literally impossible just to do it at home, especially with somebody with memory issues or with mobility issues. So something we need to plan for very seriously because it affects our lifestyle, and it also affects not only us, but people around us that we love, which we don't want to suffer. So I think it's extremely important to have the plan in place, whether it's a self-insurance or it's maybe you're having a policy in place or whatever it is, but you need to know the answers to those. Who will be taking care of me? How, when, how do I want to see it? So I appreciate, thank you, Amy. It was definitely a very, punchline to see, how things can be.
Of course, yeah. And I do think, and for those of you again that have been through it, right, you may understand, or what it's like. For those of you who haven't, then it's great that you're here today to learn more about it so that you are prepared if and when something happens to you or to a family member. And Larissa is exactly right. A long-term care event doesn't just happen to the person, it happens to the entire family. So for the agenda, what I'll go through is what is long-term care, what are the options that we have to plan for long-term care, and then really what are the next steps, and really just having a conversation about your plan for long-term care. So first, we'll talk about what is long-term care. Now, on the screen, you'll see the activities of daily living. So these are the 6 activities of daily living: eating, bathing, dressing, toileting, continence, and transferring. And really, transferring is the big one. A lot of people ask, what is transferring? It's just being able to get up from the couch over to the table, getting out of bed, just really getting around. So if you cannot perform 2 of these 6 activities of daily living for a period of at least expected to last for 90 days, that's a industry definition of a long-term care event. Now, the 90 days, that's the long in long-term care, right? So if we think about this like a hip replacement, for example, you may have a hip replacement and you can't do 2 of those 6 activities for a few weeks, but eventually you'll recover, you'll be back on your feet, and everything, will go back to normal. That's just a regular healthcare event. That's not a true long-term care event. This is something where something happens, doesn't matter what it is. And I think a lot of people, when we think of long-term care, the average age that somebody would need long-term care is currently 80. And that number is trending up just because people are living longer, medicine and technology is getting better. So we are able to heal our bodies a little bit better than before, and that will continue to improve. But right now, the average age of a long-term care event is 80. But it can be from anything can happen, and that can be the reason causing a long-term care event. So immediately I think we go to that age 80 number, right? And we think about being older, but I see so many cases where somebody is in their 40s, 50s, early 60s, has some kind of severe accident. Stroke is another one. A stroke with some residual impairments, we see that all the time, and that's happening to younger people. So, long-term care, this doesn't just happen to people who are in their 80s beyond and beyond. It can happen at any age. So in order to have the long-term care event on the physical side, that's when you'd be unable to perform the 2 of the 6 of the activities of daily living. Now, the other type of a long-term care event would be a severe cognitive impairment. So this would be like an Alzheimer's, dementia, Parkinson's diagnosis, where maybe physically you're okay. And that's what happened with my grandmother because it was early onset. She could do all of her activities, but she couldn't be alone because she was a danger to herself or others because of the Alzheimer's diagnosis. And something that I think is very interesting that we're seeing over the years is more and more cases or claims for long-term care insurance because of the cognitive issues. So again, this goes back to we're living longer, we can fix our bodies, but we haven't quite figured out the mind yet. So we're just seeing, more cases of dementia, more cases of Alzheimer's. And unfortunately, those types of long-term care events are the ones that last longer. So life expectancy for somebody with Alzheimer's or dementia is 8 to 10 years. So again, we're seeing longer long-term care events and more on the cognitive side when it comes to the long-term care issues. Um, and when we look at, long-term care, right, there's various different types of needs that we may have. So I think a lot of people are familiar with the middle one, the facility care. So that would be, skilled nursing facility, assisted living facility, right? Again, our mind immediately goes to a nursing home when we think about needing long-term care. But we also, of course, there's home care. So home care can be a home health aide, it can be a registered nurse coming into your home, a CNA. And we do see more and more cases where people are trying to stay at home as long as they possibly can, right? Before we maybe have to go to a facility. Like my grandmother, we tried to keep her at home where she was comfortable, but eventually it got to the point where, well, number one, we had to sell her home so to move her to a facility. And I think that happens to a lot of people where they don't have the money to pay for the in-home care, so they have to sell their home, so they really have no choice but to be in a facility. And then additional care services, these are things that if you haven't been through a long-term care event, you might not think about. So this would be hospice is actually considered under the additional care services, but also medical equipment and home modifications. And those can be very costly as well. So when my grandmother came to live with my mom, they had to buy a hospital bed. They had to pay for that. Um, if you need to stay at home and have to make your doorways bigger, if you have a wheelchair or a walker and you can't get through the doors, we have to expand the doorways. Maybe we have steps leading up to the house. We have to add a ramp, sometimes an elevator, handicap proof the bathroom. All of those things, if you want to stay at home, that falls under the additional care services. And again, everything starts becoming very expensive, starts adding up very quickly. On this slide, we see what is the cost of care in California. And now this slide shows average for the entire state of California. So California as a state is actually ranked 18th most expensive for long-term care costs, but that's the state average. So if you're in the Bay Area, we are, of course, just like everything else, right up there with some of the highest costs of long-term care in the country. Just as a little trivia here, Connecticut is currently ranked number one for the highest cost of care as a state, and Texas is the least expensive. So I always say, we can move locations to save on the cost of care. But in general, California on average, about 125,000 per year for a skilled nursing facility. Here, really, most facilities are starting at about 12,000 a month. And again, that's for like a private skilled nursing facility. And when I say starting, it just depends on where you are. Depends on what level of care you need. Typically, if you need some type of memory care, they add on to the cost, in addition to the room and board. The assisted living facilities are the least expensive cost of care in California, ranging from about 5 to 7,000 per month. So that would be on the assisted living side. And then for the in-home care, So I always use the number of $25 an hour, which in reality is a little bit on the low side. But if you think about it from this perspective, if you're getting care 8 hours per day at $25 per hour, already right there, you're at 6,000 per month. So that's on the lower end at 25 an hour. So and you're only getting 8 hours a day of care, which means that you have a family member who is also helping you either in the mornings or in the evenings or supplementing that care. So we can see how the costs can quickly add up. And again, some of you, if you've been through this, you may know what the costs are. But I think the point is, there are some surprise costs like the additional care services, equipment, home modifications we talked about. And then regardless whether or not you want to stay at home or be in a facility, you're spending anywhere from 6,000, 15,000 plus per month. And by the way, this is all per person. So this is only if you're married and a married couple, this is just for one person, right? That's not to say that both spouses need care. So we have to take that into consideration as well. Right now, the statistic, according to the Department of Health and Human Services, is that 70% of people over the age of 65 will need some type of long-term care. So 70% of people over the age of 65. And that number, that 70%, again, is going up because we're just living longer, right? California actually has the second highest life expectancy in the country. Number one is Hawaii. And so especially here in California, right, we're living longer. The longer that we're living, the more likely it is that we're going to need some type of long-term care. So I can pause for a second. Larissa, did you want to add anything just on cost of care or anything you've experienced with your clients?
Yes, what I've noticed is that here in California, because we are used to a higher standard of living, we believe that that can carry us through. If we don't need to stay at home and spend the money, we'll go to facility, this might be enough. But what I'm realizing that it actually probably will cost more. From what Amy is saying, it's not, if family of two can be okay to spend $80,000, $100,000 a year in the 60s, 70s, if they don't have mortgage, property tax are low, the care will be more for one person. And you imagine if one person goes into a facility and then another person needs care around the same time if they're similar age. So that becomes a huge burden. So we always say, if you are self-insured, let's make sure what the assets are allocated for long-term care, how easily we can take them out, what tax ramifications will be on that. Because $1 million allocated in IRA for long-term care is actually not $1 million available to you, because after tax payments and all the federal and state withholdings, we're probably looking more like $700,000. So we need to take into consideration how quickly we will be running of this deficit down from the account, and tax ramifications of it, and also potential outcome, what other assets will be available to you later on, because we don't guarantee how long the impairment will last. It could be 2 to 3 years, which might be okay. What if it lasts 8 to 10 years if it's a memory care? And as we see statistically, memory issues become more and more prominent as we age, and that's the concern. So thank you, Amy. I'm seeing more and more $8,000, $9,000 cost on a long-term care a month if it's a facility. So my idea, obviously, stay at home as long as you can, but make sure you get the right care, right? But yeah, that's what my comments on the cost.
Yes, and you're exactly right. And something else that you mentioned that I can speak to is we talked about if you have Alzheimer's or dementia, life expectancy is 8 to 10 years. A lot of people have heard the statistic, or they may know that the average stay in a nursing home is 2 or 3 years, right? Typically a little bit longer for women. And so a lot of times people think, oh, it's only going to be a 2 or a 3 year event. And if that's the case, there are a lot of people who have assets who can self-insure. If you only need care for a year or two, right? You might be okay. We may be spending a couple 100,000, but maybe we do have enough assets to self-insure and cover that, and that's fantastic. But the reality is that that statistic of 2 to 3 years in a facility, yes, it is accurate. However, the problem is we don't have all of the data about how long that person was at home for being cared for by a family member. So even though you hear that number 2, 3, 4 years in a facility, typically the long-term care event starts well before that. And that's my family perfect example because we tried to keep my grandmother home for a couple of years before we finally had to move her to the facility. As I mentioned, all in, it was about 7 years total from when she was diagnosed to when she passed. So, yes, if we have a year or two of a long-term care event, maybe we can self-insure. But the reality is, if you need care for 3, 4, 5, 6, 7+ years, especially per person, those are the long-term care events that are just totally wiping people out. They're ruining the financial plan. Um, another interesting fact is women outlive men on average of about 8 years, right? So we're seeing sometimes we have the male spouse who has a long-term care event for 6+ years, spending all of this money, right? And then the surviving female spouse, their assets are dwindling. Now her retirement is affected. Not to mention just the kids' inheritance, right? If you care about leaving anything to your kids. So it is a big financial burden. And again, really what we're planning for is, of course, we need to take into consideration worst case scenario. If we need care for 2 or more years, what does that look like? So when we look at planning options, so these on the screen here, I'm going to go through each one, different ways that we can help plan for long-term care, offset some of these costs. The first one would be Medicare. Now, we did a survey, there was a survey done about a year ago, asking consumers if they believed that Medicare covered long-term care costs. And it came back that 60% said yes, Medicare is going to cover long-term care. What Medicare does cover is 100 days after you've been inpatient hospitalized for 3 days. So that's a key. You have to be in the hospital for 3 days. When you are released, you can use Medicare benefits to pay for a rehabilitation in a facility or at home, but only for 100 days. After that 100 days, you have to start paying the full price or they kick you out. You have to get hospitalized again. And of course they know this, right? They know the system. So they're trying to avoid having you in the hospital for 3 days. So
I actually can
Medicare,
add something to that, Amy.
sure.
What I also learned that those 90 days are not guaranteed to you. You have to be improving. And if you don't improve within 21 days, they will let you go. So you have
Yes.
to be improving. And if you are already in a long-term care situation where you're very weak and you're not improving, I think Medicare will stop making payments and they'll make it very clear to you. And I have not realized that till I've gone through it personally with my mother. And then potentially Medicaid can kick in if you qualify. So actually those 90 days, it's just on the paper. In reality, it could be much shorter if you're not improving. So
Yes, you're exactly right. So right, the Medicare is not always guaranteed. You have to be improving. And something else a lot of people don't realize is even if you make it the full 100 days, days 1 through 20 are free. If you hit day 21, currently in 2024, the fee is $204 per day. So for that last 79 days, you would end up spending $16,000. And that's with the Medicare coverage. So Medicare, it's very misleading. You do some research, but just know that Medicare is not going to be a long-term plan for long-term care. It may help you out a little bit, but there's a lot of red tape, and also it can be expensive as well. Now, Medicaid, or in California, we call Medi-Cal, same thing. In order to qualify for Medi-Cal, you have to be down to your last couple thousand worth of assets, right? So this is income based. Of course, we hope that nobody's in that position. But even if you are and you qualified for Medi-Cal, yes, there are benefits available. However, what I will say is number one, there's little to no choice in terms of who's going to be providing you care if it's in home, or where you will be placed if you're in a facility. So I've heard so many stories over the years of family members qualifying for Medi-Cal, and they're placed in a facility that's hours away from where their family is, right? Very difficult for the family to be able to visit. The other thing is they go by beds. So there are certain counties in California that require every facility to have a Medi-Cal bed. One of the worst stories that I've heard over the years was actually a friend of mine. Her mom was in a Medi-Cal facility, and they put her in a bed. She was in the hallway for about 2 weeks before an actual bed in a room. They had to wait till somebody passed to move her into a room. Prior to that, she was in the hallway for 2 weeks. So yes, Medi-Cal will step in, and if you're down, to your last couple thousand in assets, it's income based, but it's not always, the best solution. We have very little choice and control over what is, where we're receiving care, and what type of care we're receiving. And again, my grandmother, same thing. When they looked at the Medi-Cal or Medicaid facilities, they were just not comfortable putting her in any of those. So that's just a little bit on Medi-Cal. The next is family. And, we've talked about this a little bit with my family. I think that people generally want to be there to take care of their family and help them, right? But unless you've been through the situation, you may not realize how difficult it is to be a caregiver. I always say it's nice to be able to be overseeing the care, right? And managing the care. And that way you're spending more quality time with them. If you're a caregiver, it's not necessarily quality time. Especially, if you think about anything that's bathroom related, right? I mean, I think of my dad. Of course, I want to be there for my dad to help care for him. I can cook him dinner, I can help him, I can clean the house, take out the trash, but I don't think my dad wants me involved in anything that is bathroom related. A lot of that is about integrity, and it's also really hard for me. I mean, I'm only 5 foot tall. I would not be able to lift my father. So that's one thing to consider. The other thing, Larissa mentioned this in the beginning, caregiver syndrome or I think you said caregivers fatigue, right? Same concept. You can Google it. It is a real diagnosis. So caregiver syndrome happens to somebody, especially somebody who is elderly, who is caring for a family member, and they do not realize, because they're putting so much time and energy into caring for this person, they're neglecting their own health and well-being. And unfortunately, then their health starts to deteriorate as well. So of course, families is good to have, good to be supportive, but it's really hard to put all the burden on a family member. So when we move into long-term care insurance, these are just two types of formal long-term care insurance that you can get that are available. The first is traditional long-term care insurance. And we call it traditional long-term care insurance because it's just like any other type of insurance you can get, like a car insurance, property, earthquake insurance, where you're paying into this over a monthly or an annual time frame. You typically are paying into it forever. And if you end up needing long-term care, you can use the insurance benefits that will help cover the cost of care, which is fantastic. That is the whole point of doing this. So we're putting in premiums to get a big benefit that we can use later on to pay for care. The downsides to the traditional long-term care insurance, however, are one, it is use it or lose it. So if you pay all of those premiums and you end up in the 30% that doesn't need care, you're not getting any benefit from that policy. So that's just one thing to consider on the traditional. The other is that these benefits in the traditional long-term care are not guaranteed, meaning the insurance company can come back and they can increase your premiums or they can change your benefits really whenever they want. And Larissa, I don't know if you want to speak to this, but over the years, clients that have traditional long-term care, and if you do, if you already have a policy, that's amazing. You're ahead of the game, and a very good planner. So I'll volunteer, Larissa.
Yeah,
If you
I
do
can
have
speak for that. I've seen many cases where a client comes to me and they say, I just got this bill. They double my premiums without giving me any notice. What do I do? I can afford paying it on my, income that's already been planned out.
Mhm.
Not comfortable to pay. So we have to find a solution. Either we'll reduce the benefits, or we have a combination of increasing premiums to a certain degree, reducing benefits. So I've seen it all the time. In general, I still prefer not to drop the policy, but we need to be prepared that we're at the mercy of the insurance company at that time to continue making premium payments, whatever they are, right? As people getting older and living longer, the cost of long-term care increases. So insurance company has to pass that cost to the people who are insuring themselves. And that's why it goes up, not with inflation rate. It usually increases much faster. It usually would double every 10 to 12 years in premiums. And inflation on those policies, premiums, is about at least 5% a year. So that's something to just keep in mind.
Yes, that's perfect. All good things to, think about with the traditional long-term care. And if you do happen to have a long-term care policy or a traditional long-term care, or you have a family member that does, number one, make sure your family members know about your insurance or any insurance, really, life insurance. Make sure Larissa knows that you have it. Because if something happens to you, right, we need to know, somebody needs to know how to access these policies. But I know Larissa is very knowledgeable with insurance. She can help you do an insurance review, whether, again, long-term care, life insurance. But again, just make sure your family members know that you have it, or Larissa knows that you have it, so we know where to go if something happens to you. But that's traditional long-term care. So there's pros and cons to it. And traditional long-term care has been around for a really long time. In the past, it was, pretty cheap premiums for a nice benefit, but you're also paying forever. It's not guaranteed, and it's use it or lose it. So then we move to the hybrid long-term care. And this has become so much more popular in the recent years because hybrid long-term care, we call it hybrid because it gives you the long-term care benefit if you need it. So it's tax-free long-term care benefits if we have a long-term care event, or if we don't need long-term care, it will pay out tax-free life insurance to our beneficiaries. So that eliminates the use it or lose it. So if it's either long-term care if we need it, if we don't, it's life insurance. And then these hybrid policies are guaranteed. They're not lifetime payments. So when you sign up for it, you're paying over a set time frame. When you're done, you're done. Again, the premiums don't change. So if you signed up for a premium of $5,000 a year for 10 years, that's it. You won't have to pay more. It'll be paid up, but the policy will continue, and it actually will continue growing over time, so that the longer that you live and don't need care, the more growth happens in your policy within your long-term care benefit. So again, hybrids have become very popular just because we're eliminating the use it or lose it. We know no matter what happens, somebody's getting some kind of benefit from it. And it's a nice peace of mind to just know that it's guaranteed. You won't be getting a letter from the company saying that the premiums are going to increase or your benefits will change. So I'll pause there. Anything else to add, Larissa, on
Yes, I would like to address the
hybrid?
question here. Somebody asked, does the last couple of thousands in assets to qualify for Medicaid, I would assume, will take into account value of the home and the person owns and live in general, not. I don't believe it does, but if government or state takes care of your medical long-term care bills, potentially, I don't know if the value, once the person passes, I don't know if the value goes of the property goes to heirs or goes to state. I think there might be some provisions, and Amy might know a little bit more about it. But well, in order to qualify for Medicaid, you cannot have more than $2,000 in assets besides your home, and your income has to be very low. So maybe Amy can add more to that.
Yeah, so there you can keep your home exempt from your assets when it comes to qualifying for Medi-Cal. So it's more, income based. But I mean, but in terms of income, they look at everything. So other than your the value of your property, I mean, they look at Social Security, pensions, like anything that you're getting. And if you're within a certain threshold, they'll say, okay, you need to pay X amount and we'll cover 2,000, right? So they're taking everything. Even if you do have some type of income or you have some type of assets, they will subtract that from the amount that they will give you so that, all of your Social Security, pension, any income is going to them. I actually had a situation a couple years ago where somebody had a rental property and that was like her only source of income. And they literally took the income from the rental property, subtracted that out, and then paid the difference for the Medi-Cal benefit.
Good to know. I didn't realize. Okay.
Yeah. Is there more questions? I don't know if I can see the chat.
One question I had is when is the best time to plan for long-term care, age-wise?
Good question. So you can get long-term care insurance. And by the way, if we talked about this, if your plan is to self-insure, that's fine too. Just make sure that conversation has been had with your family. Of course, Larissa, especially you, right? If we're planning to self-insure, then we need to know where are we going to get that money from, and also what are the tax implications, right? Some people say, well, I have a second property, I'll just sell that. Make sure the kids are involved, make sure your whole family is involved with whatever your long-term care plan is. If you're looking at long-term care insurance, the answer to the question is as soon as possible. It's the same answer to the question of when should we start planning for retirement, right? The earlier, the better. A lot of people wait until they're in their 60s or 70s to plan for long-term care because that's when we're closer to needing it. And that's okay. If you're in your 60s or 70s and we haven't done long-term care insurance, it's not too late. But the earlier the better. And you can go actually down to as young as 30 to get a hybrid long-term care plan. In fact, right now, this is very interesting. The average issue age for hybrid long-term care is 46. So we have 46-year-olds getting long-term care hybrid insurance because it's got the life insurance and the long-term care. A lot of people are seeing their family members go through it, right? Just like me. So we want to plan for it as early as possible. Number one, it's less expensive. So the premiums are less, you can put less premium in. And I think even more importantly is there is a health component to this. So we do have to go through an underwriting assessment in order to qualify, just like life insurance or any other insurance. If we're younger, hopefully the likelihood is we're healthier and we're able to qualify. The longer we wait, the more likely something health-wise can pop up. And at that point, depending on what it is, right, you may become uninsurable. And then you don't have any option for the insurance. So then you're just relying on family or self-insuring. So we don't want to put ourselves in a position where we're forced to self-insure because we waited too long and now we can't qualify because of some type of health event. So good question. That was a long answer, but basically the sooner the better.
Thank you very much for that. I'm so surprised. Looks like I'm late. I need to rush into looking into signing up for it. And the more I listen to you, the more I think, boy, how important it is for everybody to review it and evaluate. So the age goes down with who is interested in that, which means you have a little bit more time to accumulate the assets. And there are so many ways to do it. Lincoln has few different ways to approach that mitigation of that risk of running out of money. But there's a few other products that can potentially be the best fit. So it's not one fit all. There needs to be some research done, reviewing different policies, different illustrations to make sure it's a perfect fit, if it's a fit, right? If you cannot be self-insuring yourself, what other options you might have? One more question came here. Do benefits with the hybrid policy log in like the cost of the policy, or can they reduce or change over time?
Oh, great question. The hybrid policies are guaranteed. So the benefits can change and the premiums can change either. So it's just a nice peace of mind. You know exactly what you're getting. You can print out a copy of your benefits when you sign up for your contract and put it on your refrigerator. And 30 years from now, you know exactly what the benefits are. So it's just, again, really nice peace of mind.
Thank you.
Good question. Yeah.
Alright.
And I think that's, if any of you are curious as to what the benefits look like for either traditional, hybrid, long-term care, that's something Larissa can help you with. The benefits are based on age and gender. So women are more expensive for long-term care insurance than men. It's the opposite for life insurance. Why? Because we talked about women live longer. Uh, more likely to have a long-term care event and have longer long-term care events. So, Larissa has the ability to take a look based on your financial picture, your situation, and see what the different plans would look like for you and what would fit best for you or for your family, whether it's traditional or one of the various types of hybrids. But it's, if you're interested, it's good to look at the numbers and see if it's a good fit.
Thank you, Amy. There was a bunch of questions came in. We'll try to make sure we answer all of them. If we don't and we run out of time, we'll try to finish 5 minutes, 10 to 5 minutes before the hour. And I will be happy to address those to Amy if I cannot answer those myself. One was, what happened if insurance company goes out of business?
Good question. So in the event, if any insurance company goes out of business, the likelihood would be a merger or an acquisition. So if this happens, if there's a merger or an acquisition, the acquiring company is obligated to fulfill any outstanding policies or contracts that are already in existence. So if that were the case, if there was a merger or buyout or acquisition, whatever, then it would be fine. If that company who's acquiring the other company cannot fulfill those contracts, then the merger and acquisition will not happen. So that would be the number one thing. The second thing is, if the company just completely goes under, and obviously, right, it can happen, there's something called the State Guarantee Association. So this is something I encourage you to Google it. Every state has a different program, but it's so California, it's called the California State Guarantee Association. And it's very interesting. So insurance carriers all actually sort of contribute to this type of program, so that in the event a company does become insolvent, the State Guarantee Association has the capability to be able to pay out a certain amount of benefits. And this is not just long-term care. This is long-term care, disability, annuities, life insurance. But if you Google, you'll see right on the landing page, there's about 4 or 5 or 6 companies that are on there right now that are currently being covered up to a certain benefit amount by the State Guarantee Association. So, it is case by case. It's not FDIC, so do not confuse it with that. But it is something that a lot of people don't realize, that there is this program available, and all of the insurance carriers sort of contribute to it in case there's a company that becomes insolvent.
Well, that's great to know. Is it similar to PBGC, Public Guarantee Insurance Corporation, that covers pension benefits? So you pay into that as the premiums to protect the public? No?
Not that I'm familiar with, no.
So it's a different association.
Yeah,
Will
different.
step into in case insurance company is not solvent. I understand.
Right. Yep. Not that I'm familiar with. Yeah. So, but it's always good to do some
Check,
research on the
right,
state
right.
guarantee. Yeah,
And
that's
it
interesting.
makes sense because insurance business is where a lot of public well-being relies on. For instance, if we don't have a company pay our house repairs when we have a major earthquake and you have earthquake insurance, obviously government will need to step in. If people are paying for long-term care for years and the insurance company is not able to pay anymore, it's a public benefit that the government will insure to a certain degree, maybe not fully, but to a certain degree they will insure. And most of the time, what happens is, as Amy said, the company will be bought. They will be bought at and to continue carrying on the benefits.
Mhm.
But it is a long-term commitment. That's why we always look at rating, and company ratings has to be, A plus, A, so we're comfortable knowing that this company has been in business and doing well financially.
Exactly. Yeah. All these companies are very, very highly regulated. And when you look at, if you look at the website, they're not major names like Lincoln, MetLife, New York Life, State Life. I think there's one on there. It's like, Golden State, Golden State Mountain, insurance company, right? I mean, a lot of them are some of the smaller companies. So, when you're looking at insurance, you want to make sure that it's a big company that has good ratings, has been around for a long time.
Correct, I agree. Another one is, do the insurance plans determine which long-term care facility they will or will not pay for?
So some yes and no. There's some policies like the traditional long-term care policies typically are a lot more restrictive. So it just depends on, which type of policy you're looking at. And that's something too, Larissa can help you with. In fact, another thing to point out is the waiting period. Some policies, they have waiting periods, meaning you have to wait. It's sort of like a deductible. After you trigger your benefits, then you may have to wait a certain amount of time before you can actually access your benefit. The hybrid long-term care does not have any waiting period. So that's another factor to consider when you're looking at the different insurance policies.
Thank you, that's great.
Mhm.
Any other questions? Anybody else? You're also welcome to unmute yourself and ask the question directly, or if not, I will be happy to answer them via chat. Let me see. How difficult it is to qualify for long-term care, let's say with Lincoln,
Qualify for a policy,
for a
like
policy?
to get a policy. Yeah.
Mhm.
So not necessarily just with Lincoln and the hybrid, traditional as well. I always say, don't rule anything out in terms of your own, health conditions, but don't rule anything in. And what I mean by that is a lot of times from the insurance perspective, most people are thinking life insurance and they're thinking things that could cause them to essentially pass away. So those are mortality risks. Um, Long-term care, especially on the hybrid, right? There is a death benefit. Yes, the death benefit value is a little bit smaller. Long-term care underwriting is looking at morbidity risk, not necessarily mortality risk. So morbidity risk or things like mobility issues, right? So something that can cause you to not pass away, but live for a long time and you can't do two of the six activities, right? So when it comes to the underwriting, things like cancer, heart issues, diabetes, obesity, smoking, all of those things are mortality risk. It's very lenient underwriting for those items, right? So easier to qualify if you have, in fact, cancer, for the Lincoln hybrid cancer, if it's prostate cancer, colon cancer, breast cancer, or lung cancer, if it is stage 3 or less, they only need it to be 6 months in remission. I mean, it's amazing, right? So most people think I had cancer, I can't qualify for insurance. That's on the life insurance side. Now, on the other hand, things like physical therapy, cortisone injections, mobility issues like severe osteoporosis, severe arthritis, right? Think about that. Those are all things that are going to affect your activities of daily living. So they're going to look a little bit more closely at those items. So again, don't rule yourself out. If you're comfortable sharing anything with Larissa, she can always do an anonymous inquiry, and look through underwriting and see if the coverage would be available based on your health history or not. So, and again, anything that you're comfortable sharing, it is helpful just to look up front, because if we know that, you can't get it, then that's okay. Then we just go to plan B, whatever that looks like. Maybe we set up a separate account and we go down the self-insuring path.
Great, makes sense. So there is always a solution. Thank you.
Mhm.
Any other questions we have? It's almost 1 o'clock. It's been a very eye-opening. I learned a lot myself. Industry obviously changed a lot since I've started working with long-term care policies. There's been some good news that the policies are changing. Some of them are getting more elaborate and benefits. They understand people travel. They understand that people might need care for longer. So and also the payments. There used to be only a lump sum available. Now I believe there is like a payment plan for a few years. So definitely an interesting landscape, and we'll be always happy to take a look, review. We don't want anybody to be not protected, so we want to make sure that this is part of your financial plan. We have a plan, whether it is self-insuring or having an insurance. We just need to make sure that we checked it, comfortable with that, and we can move forward peacefully with our life without a worry. So thank you so much, Amy. Everybody seems to finish with the questions.